Right. Okay. Morning. Let's see, we have got 24 people on. I will start off now because we're slightly late. If you recall, I'm sorry, I couldn't come for the class last week. I think Nishanta did a bit of his area last week. I'm going to go back to asset and liability management. And if you recall, we have done 2 sessions on that. First session was on the basics of ALM. That's the first presentation we did 2 weeks ago, 3 weeks ago. It covered the definition of ALM. It covered what the role of Treasury is within managing ALM. It looked at the ALCO process and where ALCO sits within the overall realm of the bank, and also how ALM contributes to not only managing the risk but also in terms of the profitability of the bank. So it was very much a basic understanding of where ALM sits and what ALM does, and the fact that it is not only for risk management but also for the purpose of ensuring the maximum return for the firm and for the shareholder, basically. Then the week after, we covered went more deeply into certain parts of ALM itself, where we looked at what we call the gap analysis. In that, we looked at a basic introduction into what a gap is, and basically how to prepare a gap report, and then basically how you handle the different assets and liabilities of an institution within that, because as you know, the managing a balance sheet or managing cash flows is a dynamic process, and things don't remain static over a period of time. So there is a way of making sure that you sort of handle that situation. So that particular session, we stopped it halfway, where we looked at the introduction to gap, how you look at the rate sensitive assets minus the rate sensitive liabilities, and then what a positive gap is. So a positive gap would be where your rate sensitive assets are greater than your rate sensitive liability. So in other words, your loans and advances exceed your deposits and other liabilities that you have. And a negative gap would be where your rate sensitive liabilities, so in other words, your deposit, exceed your assets in terms of your loans. Then from there, we looked at, based on your gap position, as you would call it, whether you are a positive gap or a negative gap, how you would define your institution's balance sheet or ALM structure, or how you would define your overall sensitivity to movements in the interest rates and movements in the market overall. So if you have a positive gap, which basically means you are, as we said before, if you have more assets than liabilities, you are asset sensitive, and your assets repricing before your liabilities reprice. Yeah. Second. And if you have a negative gap, which basically means your liabilities exceed your assets, you are liability sensitive, and your liabilities reprice before your assets. So, and then we looked at, based on that, if your positive gap and your asset sensitive, how interest rate movement is basically impacts your overall position. So in other words, that it basically means an increase in interest rates results in an increase in NII, and a decline in interest rates leads to a reduction in NII. Negative gap is the other way around. So basically what you're trying to say here is your overall gap position is impacted or gets impacted by a movement in the interest rate environment that you are in and this change in interest rates. Therefore, it is important for you to know whether you're positive gap and negative gap. The other thing to realize is a positive gap usually means you have more assets, and that your assets are more or less probably short-term assets funded with long-term liabilities. And your negative gap means you have more liabilities. That means you have more long-term assets and short-term liabilities. Yeah, and basically the importance of knowing that is so that you can forecast not only where you sit in terms of your differential in terms of funding, but also how you react to possible interest rate movements. So the cumulative gap is nothing more than when you look at your gap in a certain period, what the accumulation of your at a given point in time, overall what your gap position is on a cumulative basis. So it's a gap position on times n, which is a certain time, minus 1, which is the one previous to that. Then we went into looking at the report itself and how you formulate that report. So what we mentioned is you got to figure out a few things before you get into a gap report. Number one, you have to decide on the number of time buckets you want to get into. And here we discussed the fact that having too many was as not productive, as unproductive as having even a too few. So you need to figure out the correct number based on your institution and based on how your assets and liabilities are spread out. And even within that, you've got to figure out what the length of each of the buckets are. So for example, do you go 1 month, 2 months, 3 months, 4 months, up to 12 months, or do you go 0 to 3 months? So basically every quarter. That is again determined by the amount of bunching up you have in each of those buckets and how far out you go to again, like in the first one. So that gives you the MI on a more useful basis rather than having a lot of data in that really doesn't give you the answers you want. So then once you have created that framework, you then basically have to look to slot your assets and liabilities and off-balance sheet items into a corresponding bucket, so that when you do your calculation as to how the gap analysis is, you basically have a general understanding, a fair understanding, estimation as to what your real position is. But remember, these are all based on assumptions. The data itself is actual, but how you work out and how you formulate is very much based on how you design the overall framework at the beginning. Right. So then, based on that, we just looked at a overall sort of a composition of what a good gap report might look like. Like I said earlier, it depends on the composition of the balance sheet and the purpose of the overall analysis. Generally, with what we say is something between 5 and 12 buckets is something easy to sort of manage. And like I said earlier, if you have too few or too many, it doesn't become meaningful for one reason or the other. So having the right volume of buckets and the right length is very important so that you have a meaningful analysis. So we just went on there, then after that, to look at the typical time structures and the time formulation, the buckets that you have. So you have overnight, 1 week, 1 month. But like I said, that's up to you to decide based on the cash flow that you see or the overall structure that you see. Again, looking at that, you again went into formulating 1 to 1 month, 1 to 3 months, etc., the number of gaps you have. Okay. So what is the gap? So then we looked at the gap report itself, where you have assets on one side and liabilities on the other side. And then you looked at, for each period, what your gap is. So for example, in the 3-month buckets, if we had 100 assets and you had 50 liabilities, technically then you had a positive gap of assets there of 100 over liabilities. So you have a positive 100, positive 50 there, sitting there with you. And then you looked at every period like that, you take the whole computation, at the end of it you come to the gap analysis that you have. So in other words, if I were to draw it out, you have assets here, liabilities here, the different buckets that you want to here. Say 5, you have assets of 100, liabilities of 50. On a cumulative basis, then you will have 50 positive here, then maybe you have 100 minus here, and we'll say 50 here, or 100. Sorry. You have 50 here, and you have 100 here, then you have maybe minus 50 here. So you basically work out your numbers, and then you come up with your cumulative number at the bottom there, which basically gives you your cumulative gap for those particular cash flows. Use that particular number that you get here to calculate your ratio versus assets against your total assets as a percentage of equity, as a percentage of interest earning assets that you have on or total assets that you have. So you can once you have it, you can figure out for yourself vis-a-vis all your different ratios. You can figure out how much of a impact your current gap is against your total different measures within your balance sheet itself. So what liabilities assets and liabilities do you include in the gap report? You can either have your interest earning assets and interest bearing liabilities, or you can have all your assets and liabilities. So for example, as a liability, if you look at, you can include your current account balances as well as your savings and fixed deposits as a liability. On your asset side, most of your assets will be earning you interest, but if you by any chance have some asset for whatever reason that is not giving you interest income, you can decide to, depending on how important it is, you can decide to include it or not. But I think the most important thing to understand is whatever you do, there has to be some consistency in your approach so that you are comparing apples to apples and making sure that you are getting the correct information from the correct picture from the information that you input. So, so basically, considerations when you're slotting in different items is basically on the repricing versus contractual, remaining mature versus original maturity. So what I'm trying to say here is, like, look, you're looking at two things here. You're looking at a situation when you're slotting your assets and liabilities as to when are you actually repricing these assets and liabilities. In other words, are you repricing it at contractual maturity, or are you repricing it every 6 months? So, like the example given below, if you have a 5-year floating rate bond with a coupon of 6 months, and then you also have a bond with a maturity of 5 years and maturity remaining of 6 months. Now, in this case, there are 2 points here. One is, in the first one, it's a 5-year with a 6-month pricing. So in other words, your contract on this from a liability perspective, you're repricing it every 6 months. So from an interest rates perspective, your risk changes every 6 months. So in other words, the impact on your overall cash flows and how the liability from a repricing and interest component perspective, that will have an impact every 6 months. But if it were the fixed year bond, where the interest is all determined at the end of 5 years and it's fixed for the whole 5 years, then your impact is for the full 5 years, not every 6 months. What you got to understand here, the principle of this is anyway at a 5-year period. So you got to slot that principle here on the 5-year, but the interest fixings and the interests are done every 6 months on the first one. On the second bond, where it is maturity at 5 years, if it was a full 5-year period we're talking about, then you have to look at it at the 5-year bucket with the 5-year interest rates impacting at the end of 5 years. But here, as you can see, there in the second question, there is a maturity of 6 months. So in other words, it's not in 5 years, it's only 6 months. So if it was a 6-month bucket right on top there, it will sit within the 6-month period because of the fact that it is maturing in 6 months' time. Yeah, so if you have in the first one, where you slot the items, remaining months, 2 months, is 2 months in this, sorry. Yeah, so if it's 2 months, you put it in the 2-month bucket, reprice in 6 months. Basically, what you have to do is, if its maturity is 2 months more, you have to price it in the 2 months, because ultimately that's where you're looking at the repricing happening and where the maturity will be paid. Yeah. Then we looked at how to handle amortizing loan, and where you basically would slot your different loan payments, and how you would look at where the bank would tell you, look, you have equal monthly payment of 10,000 rupees, but what is the principal component and what is the interest component into that, and where will it end up in each bucket. Now, for that, we looked at this formula. I told you guys to have a look at it when you're working at home. But basically, what it shows you is when you're working out on a certain interest rate, because ultimately, what do you know? You know the amount of principal that somebody wants to borrow. You know the number of months or years or whatever for the repayment, and you know the interest rate on that. So what are you trying to get at here? You are trying to figure out, ideally, in this particular example, they've given you the present value and what the payment is, and when they've given you the present value of that, they are asking you to get what the payment is, or the amount you have to principally pay every month. So now, in this case, you know there are 4 payments. It's a 10,000. The present value of the money that you're taking is 10,000. In other words, the bank is giving you 10,000 rupees now. And what they're asking you to do is calculate what your monthly payment will be for the next 4 payments that you have to make. So you plug in the data into this factor to find A. And based on that, I think the most important thing is for you to understand is, look, the interest component is known at the beginning because you know your 10% is going to be paid for 10,000 rupees. So that's 1,000 rupees for the first payment, that interest payment, which is assuming it's at the end of every year. And then if you know that your payment monthly based on this formula is 3,155, your principal becomes 2,155. The trick is the next month, right? You got to figure out, you know your payment is 3,155, then your interest changes. So basically, you know your total payment, which is basically interest plus capital, has to be 3,155. But remember, your balance has now reduced further. It's 7,845. So now the PV that you're talking about here is 7,845. So when you plug that into the same formula, what will happen is you will get interest of, say, 784, because 10% of this is 784, and the residual amount will be your principal. So in other words, your principal starts to increase and your interest starts to go down because the balance is every year on year going down. So what happens here in this purpose, 2 things are happening. You are giving your client a certain fixed payment schedule because the interest rate you're paying is fixed at 10%. And your principal, and because of that, but you know that your interest charge will always keep coming down and your principal will increase. So in other words, you are reducing your interest, increasing your principal, but you're keeping the payment static. That way, we can predict exactly how long it will take for you to be able to completely pay the loan. So in this case, we using a gap analysis. What would you do? You would then put each of these lots. So look at the first year. In the first year, you will say you're getting 2,155 of your principal back. The second one, you're saying you get 4,977 of your principal back, which is basically the accumulation of, so this is 2 and 3 years. So you're getting these 2 here. And in the 4 to 10 year bucket, which basically is 4 years, 4 years plus 4.5 years roughly, I guess, you're getting 2868 here, which equals your total principal amount of 10,000. So in other words, you are calculating on your particular asset that you have created on your books, how long it will take for that to get fully repaid to you. And you need the interest rate on this, because without the interest rate on this, and if it was say a zero coupon where you are not getting paid any interest in between, it will be 2,500, 2,500, 2,500, or 2,500, 5,025 plus the interest at the end of it, basically. So in other words, you need to know what the interest component of it is, so that you can determine what the principal amount you get paid every month is. If not, you will every year. In this case, every year is. If not, you will not be able to calculate this. And if you can't calculate this, you can't actually slot the correct amount of assets that you are going to have maturing for you at that particular time period. And then, like I mentioned, if it's zero coupon bond, you basically put the maturity proceeds, where the maturity proceeds of those are in each of the buckets. Basically, what the cash flows coming in at a particular time in time, a particular point in time. So, liabilities, we looked at, say, a 3-month certificate of deposit, and then we said, look, if it's a liability, you basically slot it in the corresponding maturity of the liability as defined in the contract. Now, it becomes a little more tricky for liabilities, deposits that do not have a contractual period. So, for example, savings accounts, all kinds of these accounts that have different, no specific maturity periods, even to an extent like money market accounts, etc. Because you really don't know when those deposits will be taken away, or when the liability amount will increase, for that matter, suddenly because of whatever reason. So what you do then is you do a statistical analysis based on your typical past trends of your assets and liability, and say, okay, most of my savings accounts have behavior of being with me for say if you have 100 million savings in her savings accounts, you can say like 50 million of it sticks around for 3 months, 75 million of it sticks around for 2 months. So you do a statistical analysis and come up with a number there, and then basically you then would slot your assets, your liabilities into those various buckets based on the analysis. Like I said, this is not a perfect science, and any sort of anomaly or sudden event or sudden disruption can happen, but this is to the best efforts based on your past trend. You can basically make sort of statistical analysis of the situation. Onto that, you basically also then have for liability, for assets as well, that's liabilities. You could always have cases where people are prepaying your loans. And then basically you have to make an assumption outside of your usual amortization, your usual repayments. In the case of a prepayment, exactly where what the estimate of that prepayment will and where would it basically sit. Yeah. Now I would give you a real life example. If you look at the current situation where rupee interest rates have come down, and then some people may have borrowed floating or fixed rates at high rates. Floating, of course, no problem. But if they are borrowed fixed at very high rates, 13, 14%, current interest rates are maybe 9%. I know there will be prepayment penalties because people are making a contract. But even then, even with that prepayment penalty, there could be people who are looking to reschedule their loans and prepay their facilities early, because maybe they are borrowing from another institution. Maybe they have their own personal funds which are on deposits, which they prefer now to use to repay the loan because deposit interest rates are down. So whatever the reason, the prepayment rate in this current environment would be higher than, I would think, would be higher than it would be in a normal situation where rates have not moved down so rapidly. So in that kind of scenario, you've got to look at the situation and analyze to see, okay, fine. in this current situation, what do we do? How do we manage the overall forecasting that we do for this gap analysis? Let's look at how we can sort of get these prepayments in a more robust manner. Then we will look at a swap, where basically what is an interest rate swap? A swap is where somebody would basically swap their floating interest rates to fix, or fix it to floating, depending on the situation. Now, what you got to understand is, depending on whether you are paying fixed or receiving fixed, your swap will sit on a certain path. Now, as if you are, in this case, the example that was given is that you pay fixed 10%. In other words, you are fixed into paying somebody 10% interest over a period of time, over 5 years, and you are receiving the SLIBORs. In other words, it's like equivalent to you borrowing on a fixed basis for 5 years at a fixed interest rate, although it's a notional amount you're talking about and not really an actual cash flow movement here. And basically, because still you do have a liability and you do have an interest component that you have to worry about, the liability that you're talking about now, in this case, I'm sorry, we don't indicate whether it's a principal only, interest only, or principal exchange, but assuming that you have a liability of 5 years, that liability will be shown in the 5-year bucket and an asset of 100 million in the 6-month bucket. So in other words, why are you showing it as a liability in the 5-year bucket? Because you are paying, it's effectively you're paying fixed for 5 years, and it means you're paying interest on this for 5-year period, and that basically is a fixed rate for 5 years, irrespective of what happens with the floating rate. But at the same time, you have also contracted on the same swap, where you will have an asset where you're paying 6-month floating SLIBOR over every 6 months. In other words, the assets and liabilities negate themselves, right? Because there's 100 million liability and 100 million asset. However, the interest payments basically get slotted in on either the 5-year bucket or the 6-month bucket, based on how the interest is charged. So in this case, the interest rate is floating for 6 months. So in other words, every 6 months, you have to pay a floating interest rate to whoever. So your 6-month, you have a 6-month 5-year liability and a 6-month asset for 5 years. And then we also spoke about how to handle multi-currency. We didn't touch on it too much, but it is better, what we discussed is to have a consolidated gap report rather than having in different currencies if you have a lot of them, because it becomes meaningless and you can't use them. Then again, we went, but we already discussed, if you have an increase in interest rate, how it impacts your positive gap and negative gap. To summarize, so basically again, repeating it, if it is an increase in interest rate, you have a positive gap, it is positive for you in terms of NII. If it is a decrease in interest rates and you have a positive gap, it is usually negative for you. And then you have a negative gap and interest rates increase, it's negative for you. And if it's a negative gap when interest rates decrease, it is usually positive for you. Why are you looking at this? What you got to also understand is, although that is a very straightforward and linear way of looking at it, the actual situation could be very different, because depending on where exactly your bucket, in the buckets your assets and liabilities are, the mismatches within each bucket, the degree of mismatches within the buckets, and then based on that, how the interest rates have impacted through the curve will have an impact on the NII straight away. So it doesn't actually mean that across the board, unless your assets and liabilities are distributed evenly, if you have more assets, say, sitting out in the far end or in the near end or whatever, timing of the rate changes or the degree of rate changes and how it has basically gone through the entire period will have an impact on the actual NII itself. So it's not always straightforward to estimate that. And like I mentioned the other day, I think the shape of the interest rate curve that you have. So when you say interest rate shape, we're talking about whether it is a sloping interest rate curve or a. So you have different shapes. You have, this is the normal interest rate curve. And there will be an inversion here, or it could be like this. This is a downward sloping one, but it could be more like this. The interest rates are like this. Okay, or you could have a flat curve like this. So depending on what kind of interest rate, even if interest rates were to come down 1% here, does it come down 1% here? It might just come down 0.5% here. So depending on how the interest rate reaction is on each of these buckets that you are, the net interest income that you earn or lose out on could also change. So right, I think that is where we stopped. And I want to continue from there. Before going ahead, I've been speaking throughout. I just want to give you all a recap on the where we ended. Any questions, please, before we go ahead? Can you all hear me? Is it clear? And can you all see the board? Because we've got a new camera here, that's why.
Yes, sir.
Okay. Any questions, please, before we go on to the next one? Because I just wanted to make sure that we had a recap before we get into that, so that we are clear about where we are. Okay, good. I'll just go on to the next section then. So now what we're doing is, where we stopped here, we are trying to estimate the impact of a rate change of 100 basis points. So basically 1% interest rate change and the impact of that on NII. So what are we trying to say here? So let's look at, this is slide number 31. We are back on. Sorry about that. There was a power outage and everything went out. So we stopped at what we are looking at how interest rate change will impact NII, and basically how we have to look at it from a gap perspective. If a change in rates, how we look at it in terms of how it impacts the overall impact of the NII for that particular period. Okay, so what we are doing here is we are looking at a scenario where there is 10,000 rupees. The rate change is, I'm on slide 31. Rate change is 100 basis points, so 1%. And then we have a quarterly, we are looking at the impact on a particular quarter. Yeah. So the 3-month gap we are talking about is 10,000. So basically, you've looked at assets and you've looked at the liabilities for that particular 3-month period, and you say, look, we have a gap of 10,000 there. Yeah, we have 10,000 as a gap. Then we have the rate change, which is basically 1%. Yeah, so you have 1%. Then you have a quarter. So the period is a quarter. So we are talking 1% per annum. So then, in other words, you're talking, when you say quarter, it is for one quarter, what the impact is. And then, because why your question is, why is that half there? The half is there because you are trying to look at what the impact on average is for that quarter. So in other words, you're not taking a full 3-month period because you might have 1 month, 2 months, 3-month buckets there. You're looking at it average because you want to get the average impact of the move in 100 basis points, 1%, yeah, on this 10,000 gap for that particular period on average. So the answer becomes, when you solve for this equation, becomes 12.5. So in other words, sorry, 1 second. So basically what I'm saying here is, if interest rates move by 1%, okay, let's forget about whether this is a positive gap or negative gap for the moment. The gap you have within asset life is 10,000. The impact you're going to have is 12.5% on this for that particular bucket. Yeah. Now you're looking at it for an average. Now next slide, if you look at 32, it forgets about this average. Okay, and it just says, look, for the full period, if all your assets in this case are sitting in the 3-month bucket. Yeah, so sorry, on the lower end of the bucket, at the 1-month bucket, we say, yeah, or before that. A change in 100 basis points will have a 25% move, a 25% impact on your NII. And if all the assets are sitting in the further end of it, okay, then what happens? Impact of it is 0, because ultimately everything is sitting in the last bit of the bucket. So what are you trying to get at here? You're trying to see for each of these gaps, each of these situations, right, what the change in interest rates and the impact it has on your NII. So 12.5%, 25%, whatever it might be. So if you look at the example in slide 33, it becomes a little more clearer. You can see you have assets of 100,000, you have liabilities of 40,000. You have a gap of 60,000, yeah, for that. That is for 3 months. But then again, you look at the period between 3 and 2 years, you don't have anything. No assets, no liabilities, right? Again, your next lot of assets and liabilities come over 2 years. So you have assets of 150,000 and you have liabilities of 210,000 over the 2-year market. They don't give you the specific date there, but this says over 2 years. It could be 2.5 years, it could be 3 years, it could be just 2 years and 1 month. So now, how do you calculate the impact of that on your NII? So now here the rate change is 100 basis points again. So now look at the first one. You have a gap of 60,000, this one, yeah? And if you assume that all your items are spread, so here you have a what? You have a positive gap of 60,000 on your 3-month bucket, yeah? So if you assume that your items are evenly spread out across the bucket, and the rate change takes place instantaneously. So in other words, the change of interest for that 3 months is spread across the 3 months evenly. Yeah. For that quarter, you have 60,000, which is the difference between the assets and liabilities, positive towards your asset side. You look at 1/4 because it's quarter. You look at the 1% and you assume it's across everything evenly. So therefore, you average it, get the average impact on that particular quarter, and you end up with 75%. So this is the interest rate change has a 75% impact on your 60,000, or 75 impact on your 60,000. Now, or you can just look at it. If you look at it, it's the same thing. Look at 12 1.5 over 12. Basically, what you're trying to say is, look, instead of looking for 3 months, you're looking for 1.5 months, which is effectively the same thing. Comes up to the same 75. Yeah. So here you're getting a 75, which is the impact of an NII change. So there is a 75 rupee change or impact on a 60,000 number that you have. 60,000 number that you have will have a 75 rupee change on your NII if it moves by 100 basis points. Now, it doesn't say higher or lower, but it depending on which direction, this will be positive or negative. We'll come to that. So then you look at the period from, now you've looked at 0 to 3 months. Yeah. Your next lot is, now we got to figure out for the period that is in between that. So what were the 3 periods we had? We had 0 to 3 months, we had 3 to 2 years, and we had greater than 2 years. So now you look at the period between that 10.5 months, which is the average period we looked at here. These two. So you look at the period what you have not looked at now, which is the 10.5 months to 12 months. To figure out for that particular bucket what your impact is. Then you get that at 60,000. It's for the same 60,000 you're looking at. Yeah, remember that because it's continuing on from here. Whether that 60,000 has an impact on you for the year, what the impact on that for the rest of the year is, right? You look at that into basically 10.5 months curve into the 1% change, and you realize for the whole year, if you take it over a 1 year period, that has a 525 impact on your NII, 100 basis point change. So now this is taking the assumption that this 60,000, right, will continue on for 1 year, and if it continues on for 1 year, the impact is going to be 525. Yeah. Then,
so one question, like this 60,000 is the difference between assets and liability.
Correct.
And 1 over 2 means?
Because you're taking only for an average.
Okay, it's a norm, like
No. There is. I mean, this is just like I said. If you look at the previous example, depending on if you have more assets sitting in the 1 month, you can take it for the full period.
Okay.
It depends on how your bucket is. So this is taking the assumption that the assets and liabilities, or in this case, the asset in this case is evenly distributed over 3 months. That's why you're taking the half. If not, you can just take the quarter, or 1 quarter, or not average, or whatever it is. But here it's assuming that over that 3 months, because it's not going to 1 month, 2 months, 3 months, right? Because it's not being specific on each of those buckets, those granularity is not there, you're taking assumption of half.
Okay. Then 1/4 is the quarter.
Quarter, yes, exactly. So basically you're looking for the quarter. So your 1%, this is per annum, so you're trying to figure out what the impact is for a quarter.
Okay, 1 over 100 in the sense
1%.
For the 100 BPS.
100 BPS, correct, 1%.
That
so
is 1%.
It's not putting 1%, putting 1 over.
Okay. If some gives us the whatever the percentage, we have to use the same percentage instead of the one
Correct. So if the interest movement is say 0.5%, it will be 0.5% is listed, you know.
Yeah.
If you're doing that, you do. It's a percentage basically to calculate it.
Okay.
So it's always what happens is they look at it from a basis point. So you look at it from 100 basis points is 1% basically. So generally people look at it, I mean, if they increases and decreases, the interest happens in quarters, halves, and 1% generally. So So that's why they go down to basis points. Basis points. So if you hear somebody has changed interest rates have gone up by 25 basis points, it's 0.25% basically. 50 basis points is 0.5%. 100 basis points is 1%. This represents 100 basis points.
Okay.
Is that clear, Ruchir?
Yes, sir. Yes.
Okay, so then we go into for the year the assumption of exactly how much it is, the impact is for the year. So basically in this assumption, we are taking the fact that we know that for the first quarter it's 75. Yeah. For the remaining quarters for the year, as you can see from this, we don't have anything. So you are trying to assume up to that from there, what is the impact of the same scenario continuing into the next 1 year or the next 3 quarters, yeah, for the year. Now, when you look at the full year, you can see based on the remaining, you've already calculated for average, so basically 1.5 months for the first quarter. Now you know for the full year, remaining year is 525, right? So what you're trying to get at here is you're trying to see for each of the quarters, the full impact, like Ruchir just asked, would have been 150. We didn't average it. So if you took 150 into 4, that would have been 600. Agreed? But instead of 600, because of the first 3 months, we know what the number is and what the impact is, we are taking only 75. So because we're taking only 75, for the remaining 3 quarters, if you take the full impact of it throughout the 4 quarters, the quarter, the impact is going to be 150 per quarter. So there are 3, so that's 450 plus the 75, that comes to 525, which is the number that we have here. Yeah. Why are we doing this? Because we need to estimate, although there are no assets and liabilities mentioned there, we still need to estimate that, look, what is the impact of this going to be for the remaining year? We don't have assets and liabilities, but at the same time, you have to make an assumption that for that particular quarter, if the same picture continues on to these, what the impact is. And there you take the full impact of it because you really don't know. So you're taking the full impact of it at that point in time. And then you go, yeah, so then before we get into that bit, we are looking at the emphasis on the limitations of this. So what we are trying here, so now here we stopped at 1 year, right? So there are assets and liabilities about 2 years, but for this year, because we only know the number for 3 months and we don't know what it is for the remaining months. For this year, we are saying the impact of 100 basis points for this particular year is going to be around 525 rupees per 60,000 rupee gap that we have. So then we are not talking about anything beyond a year for the moment. So what happens now? What is this? Is it a positive gap or a negative gap? What is this gap that we have for 3 months? Positive or negative? RSA minus RSL, positive or negative? Assets minus liabilities, what is it? Is it more assets or more liabilities?
Negative gap, no?
No, it's a positive gap. There's more assets than liabilities. So, yeah, it's a positive gap. So if you look at, I'll just take it here.
Positive.
So it's a positive. So if it's a positive gap, and if it's a positive gap, so we established that. Now, what has happened with interest rates? Now we are saying 100 basis points move. We are not saying higher or negative before, higher or lower before. Now we are saying interest rates have risen. Okay. Now interest rates have gone up. You have more assets than liabilities. You have a positive gap. Yeah. interest rates go up. So what do you mean by having more assets? You have more loans given out than you have liabilities taken on the same bucket. Yeah, interest rates have gone up in the short term. Is it good or bad for that particular bucket? Interest rates have gone up. Is it good or bad? You have more assets than liabilities. You have a positive gap. What did we say? If you have a positive gap and interest rates go up, it is good for you or bad for you? Positive or negative on NII? Think of it very practically. You have given a loan that is 3 months. You have more loans that you have deposits for 3 months or 1 year, whatever. And now interest rates have gone up, right? So you have more loans that you have deposits. Interest rates have gone up. Is it good or bad for you?
It's good.
Bad.
Sorry?
It's good.
It is? You're saying it's bad? Think of it, right? You have given more loans than you have taken deposits. So therefore, you have a positive gap. Interest rates go up, right? But this is based on the fact that this is you have taken less loans, right? If interest rates go up and you have more on the shorter end, right? In other words, your assets are getting repriced. You have more assets in the short end, which basically means if interest rates rise, you can basically, your interest rates on your assets, you have more assets than liabilities, so therefore you will make more money. In other words, it's positive. So for example, look at this. You have 100,000 assets. So you increase your loans there, but the loans you are given out on these 3 months, you will increase your interest rates on that. So you will get more interest on that. Now your liabilities, you have 40,000. So now you will also pay more for your liabilities, right? But you are carrying a positive gap. So when interest rates go up and you have lent more than you have borrowed, at this particular bucket, which is floating, you are going to be earning more interest than you are paying more interest on the loan. Yes, liabilities also will go up in the same. So 1% up means you will have a positive, you have to pay more on your deposits as well. But remember, you have more assets. So your earning is going to be more than your spending. Is that clear? Because it's just a mismatch in the cash flows. If you had equal amount of assets and liabilities, whether interest rates go up or not, doesn't matter. It doesn't matter. Here you have created more assets. Say, for example, if your assets were in 1 month and your liabilities are in the 3 months, so you are paying a 3-month deposit, 40,000, 10%. Your asset you've been collecting 12%. Now the 3 month, suddenly interest rates go up today. Your 3 month is going to be still paying. You are going to be still paying 10%. Your liability, your asset, which is at 1 month, you might charge up to 14%. That we don't know those details because that's up to 3 months. We don't know whether 1 month, 2 months. That's why we looked at average here. Yeah. But on the simple assumption that you have more assets and you have a positive gap here, you have a gap here at 525, it means that if interest rates go up and you have more assets, you're going to be earning more. And if the interest rates go down, you're going to have a negative gap. So that is where you decide whether this is positive or negative. So if interest rates go up, right, that means you're going to have a positive movement in your NII of 525. If interest rates go down, you have a negative movement of 525.
So here one problem here. Yeah,
Sorry, I didn't get you.
Sense like, yeah, positive gap in the sense like you have more loan than depositors.
That's correct. That's correct.
They are the positive gap.
Sorry, go ahead.
And that means rate sensitive as well as more rate sensitive assets than rate sensitive liability.
Exactly correct. Yes. Yes. So, but at the same time, I must tell you that if you have all your assets in 3 months in that bucket, right? If you have all your assets in 3 months, right? And you have fixed it for 3 months at, like I said, we said 12%. And you have your liabilities at 1 month, yeah? At 60,000 liabilities, at 40,000 liabilities in 1 month, right? Interest rates go up, you can't reprice your asset for the next 3 months. So your asset is stuck there. But your liability, you will have to reprice every month. So, like I said, this is not a perfect science. If you have more details, you get a better understanding. Because then in that kind of scenario, your liabilities will go up, but your asset is still stuck at that level. So then, just by looking at assets and liabilities like that, you can't really say it's 525 positive. You can't.
Yes. My question is now, once we took like positive gap,
yeah,
positive gap in the sense you can you have more assets that means loans.
Correct.
But suppose like you lend long term.
Okay.
Lend long term, borrowed also the long term. Then no issue, is it?
Then no issues. Again, then it will happen on where when you say long term, short long. Okay, for example, if you have lent 100 for 12 months and borrowed 100 for 12 months, right?
Okay.
And interest rates change by 100 basis points in the same way in the same period. Then nothing happens.
Then issue comes once lent short term but borrowed long term.
Lend short term, borrowed long term. Then in that case, if interest rates go up, it's good for you. Sorry, you said lend long term or borrow? Sorry, you said lend long term.
Lend short term but borrowed long term.
Yeah, it's good for you, right? Because if you, that means you've taken a deposit at 10% for 1 year, and you have lent out today at say 10% for 1 month. The interest rates go up by 1%, right? You immediately your 1 month lending becomes 11, but your liability, your deposit is the same at 10.
That means when it comes to positive gap, you can see two scenarios. One is either you can see lend long term, lend short term, there is no impact. But impact is on when lend short term, but borrowed like borrowed for long term. That means deposits on long term. On that occasion only we can
that is
earn
why,
as well. Like
exactly right, and that is why we say that you can't just simply look at the interest rate movement. If you look at one of those slides that we did, you can't simply look at the interest rate movement and say this has a positive or negative impact based on your simply looking at your cumulative gap. You have to look at each of the buckets, right, and that you're in, and how the impact is for each of those buckets based on the distribution of assets and liabilities. You can't just look at the cumulative risk. You can't just say, look, oh, I have a positive gap, therefore interest rates go up, I'm going to make money. No, you can't. There are within that.
And when it comes to these sums, like this as an example, like I couldn't get like how you got 1.5, like 1.5 upon like over 2. That means
that's basically 10.5 months. You're talking about this one, right?
Yeah, second one. Yes, second one.
This one, 10.5.
60,000. Yeah, 10.5 over 2.
Yeah, so that is basically, this is you're looking at the first quarter, which you know what you have. So you're looking at the average. Now the remaining year, you don't have any cash flows because they are not giving you any cash flows. You're saying, but you have to because you have beyond 2 years as well, right? So now the problem is here, you don't know what the period from here to here is, right? You don't have anything. So you're assuming that this 60,000 that you have is going to continue for the remaining 1 year. Now, you've already calculated for 75, which is basically half of this period. That means you have not calculated for the remaining 10.5 months. Because this is effectively for half of 3 months, which is 1.5 months. This is calculating for the remaining.
Yeah, one question, how we arrived to 1.5 months? Just bit like confused.
10.5.
1.5 months?
Or this one.
1.5, yes. Yeah, here the sum on slide number 34,
Yeah.
1.5 months. How
Yeah,
you
half,
arrived to
half.
1.5
This is
months?
half. This is half. Half.
Okay.
So
Okay.
the half, same question you asked before. If I didn't take the half,
Okay.
I'll be looking for the 3 months, right? So I'm assuming, because I don't know what the period 1 month, 2 months, 3 months is. I don't know what the exact numbers are, right? So I'm assuming this is the average for that quarter. Average meaning half. So you can easily say if everybody says like everything is in the 3 month bucket, then we don't have to have this. We can just look at it just without this. Just without this here. You can just look at it with this. And it will be 150. That's exactly what we've done for the remaining quarters. Because we don't have a number there. A very simple calculation, you've looked at it for the quarter by quarter by quarter for the remaining part of the year. It's just an assumption. That is simply an assumption.
Okay.
Because
Okay.
you have to assume that you have something. So unless you have more specific data, and if you say you don't have, then you have to assume your current situation will get rolled over for the next 3 quarters. But it could be different after a while. Tomorrow we go, somebody gives you a deposit or takes a loan for that period, you have it. You have a different picture. So
Okay, sir, thank you.
That's a good segue into the limitations. It's basically a lot of emphasis on the near term because basically you don't know what your long-term assets and liabilities might be. You have no way of really forecasting some stuff. So it's looking at what you have now. In other words, it doesn't take into account major shifts in your balance sheet over a period of time. Yeah. Then basically there are mismatches there within each bucket. So I think the main thing you all can see the limitations that are there. This is not a very flexible situation, right? Without going into too much of it, it doesn't take into impact the interest flows and how you reinvest it, and maybe interest rates changes within that reinvestment risk that you run. It looks at the market value instead of the book value. It looks at the book value of it, where you put it instead of where it might be in the market, might be a different value. So there are different sort of limitations, and it's very static. So, but it is sort of a gauge or simplistic understanding of what your asset and liability situation is, and where, if there is an interest rate change, it can impact you from. Yeah, so like it says, when you look at the gap, it might result in your positions changing rapidly on a day-to-day basis based on how the interest rates move. So you should not rely on this alone. You have to look at it as part of a overall understanding based on all the other reports that you get from finance and everything else, just to understand, look, where do we sit on an overall basis? But this should not be sort of thing like what Ruchira was asking. There are various limitations here. So you should look at it as a general understanding of what your position is, not as the sole go-to sort of basis of doing it. Advantages is very simple. It's people know about it. It's tied to sort of accounting standards, and it's a reasonable indicator for a simple balance sheet. But the more complex you get, the more products you put on, the more optionality you have, the more changes you have, then you may have to look at more sort of advanced techniques to identify your rate risk. Let's not go into that. Okay, I'm just going to jump to the questions here. The rest of it is not too important. Let's look at slide 43. Okay, so question is, if you have a 5-year loan of 10,000 at a 10% interest rate, repayment of principal is at the end of the 5 years, interest is paid at the end of each year. So 5 years, 10% each year. And then you have a 5-year loan at 10% interest rate, repayment of the loan and interest is made in a single payment at the end of it. Okay, first one, where do you think, which bucket do you think it should be in? You have a 5-year loan of 10,000 and interest rate of 10%. Pay principal is at the end of 5 years, interest is paid at the end of each year. What do you think the cash flows will look at there? So it's an asset you have.
1 year.
Sorry?
1 year.
So the first one is a 5-year loan, 10,000 at 10% interest. Repayment of principal is at the end of 5 years, interest is paid. So how do you map out the cash flows for that one? Let's not worry about the calculation, just figure out where you put what. Okay? So now 5-year loan. When is the repayment happening in that full loan?
At the end of 5 years.
So where does the principal go?
Bucket 5.
Okay. Is there any principal repayment in between?
No.
Okay. So you have 1, 2, 3, 4, 5. Loan number 1 and loan number 2. Okay. The first one, principal. Where is the principal paid? Principal is paid at what period you said? End of 5 years, right?
Yes.
So the principal gets paid here. Okay. Then what about the interest?
Annually.
Annually. So in other words, 10,000, 10% interest basically means 1,000 rupees. So basically, without going to calculation, interest is paid here, interest is paid here, interest is paid here, interest is paid here. And then here you have principal plus interest for that year. Correct? Is that correct?
Yes.
Second one.
Yes.
5-year loan, 10,000, 10% interest, repayment of the loan and principal interest is made in single payment at the end of 5 years. So what does that mean? When is the principal paid? The second question, the second part of 5th year. So again, the principal is here. Yeah. Can you see the board?
Yes.
Okay, so principal stays here. Okay. What about interest? Where is interest coming?
End of 5th year.
End of 5th year. So you have principal plus interest here. So nothing here. Nil, 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 nil. Correct?
Yes.
So basically, on this particular asset, all your cash flows are going to come back to you. Here, it's a 5-year asset. Yeah. In this one, it's also a 5-year asset, but you're going to get your interest annually. So you're going to get some cash flows from your interest annually, but not your principal. So say this also very much is 5 years with only the interest being apportioned over 5 years. This will get you a compound interest at the end of the period. This will give you annual interest every year, effectively the same interest impact. And your only thing that your interest is staggered, you get it more often. But interest rate wise, it'll be either this will be effectively 10%, this will be 10 plus, the cumulative impact of the 5 years. That doesn't really matter. But in both these cases, your principal comes at the end of the period. Is that clear?
Yes, sir.
Okay, second one. Go back, go forward. Sorry. Where did I go? Okay. Okay, that's simple enough. So other one is about altering the gap. So that's how you probably you will slot it in based on your analysis that way. Now, altering the gap, it's nothing more than changing your report based on your changes in your assets, liabilities, and your interest rate. So in this example here, you have your assets in the first row, liabilities in the second row, and then you have your gap based on your assets and liabilities, right? Then you have your cumulative gap, and then you have it as a total of percentage of total assets. So in the first row, you can see in the 3-month bucket, yeah, you have 100 assets and you have 200 liabilities. So you're negatively capped, right, of 100. Cumulatively also is 100 because you're starting from there. Now, in that, if you look at that against your total assets, right? If you look at your total assets versus that, you have a 10% negative gap. Yeah. Now, that is your total assets. Huh? So you're looking at everything that you have. So your total assets here is 1,000, the far right-hand row here. Yeah? Against that, the cumulative gap here is thing. So you have 10% negative gap in your 3-month bucket. Yeah. In your 4 to 6 month gap, you have 15%. Yeah. And then in your 7 to 12 months against total assets, you have 35% negative gap, right? So now, what are you trying to get at here? You're just trying to understand against your total assets in each of these buckets, if the interest rates were to change, right, what your impact on your total asset portfolio versus your total asset portfolio is, how much of a percentage of your assets are sitting, what the impact of a change would be in terms based on the gap that you have with your assets and liabilities in that particular bucket. And these are the limits given for each of the. So this way you can figure out. So for example, on your 3 months, you can have a plus or minus variation of 5%. In your 1 year, you can have a plus or minus variation of 20%. So why are the limits there? Okay, so this basically, I'll just touch on this a little bit. You have a report, and that tells you what your limits are. What the management is telling you, look, in the 3-month bucket, we are only comfortable with you having a gap of plus or minus 5%. In the 1 year, we are only comfortable with having a gap of plus or minus 20%. First and foremost, tell me, based on the report here, have you breached the limits against total assets?
Yes.
You have. You have on both occasions. So what do you need to do to rectify yourself? What do you need to do to manage the situation?
You need to take strategies to come into the limit.
You need to, sorry Ruchir, I didn't get you.
You need to take strategies to break the limit, like either asset side or liability side.
Raise the limit. So you can't raise limits. This is the comfort zone. They won't allow you to raise limits. Then what do you do?
You need to work on assets or liabilities.
Yeah, exactly. So you need to either increase your assets in this case, or you need to decrease. You need to decrease your liabilities. That might be the case. In a way that you are more within your limit. Why has the management put this for each bucket? Why have we put these limits for each bucket?
In order to maintain the liquidity of the maintain the liquidity, like
Could be.
Example. Yeah.
Another reason. Liquidity, yes, could be, but one of the main reasons. Why are we looking at the gap analysis? What's the main idea about looking at gap analysis? You are looking to see what the sensitivity towards what. What are you trying to look at? Sensitivity towards what? In this case, in the first bucket, is it a positive gap or negative gap? 0 to 3 months bucket, is it a positive gap or negative gap?
Negative gap.
Okay. So when you have a negative gap, if interest rates go up, what happens? The interest rates go down. Sorry, the interest rates go down. No, sorry, my apologies. Interest rates go up, what happens? You have a negative gap.
Yep.
Interest rates go up. What happens?
You have to pay higher interest.
You have your NII should go down because you have a negative gap. Interest rates go up means you pay
Interest
more on
cost
your
will increase.
and you get more on your assets, correct?
Yeah.
You pay more on your deposits. And obviously, we have to look at the timing, like I said earlier, but assume everything is equal. Just on a simple assumption, if interest rates go up, you have more deposits, 200 deposits. Yeah. And you have 100 assets. So interest rates have gone up. Your deposit gets repriced at a higher rate. And your assets get repriced at a higher rate, but a lesser amount of assets. So in other words, what happens when your interest rates go up? You get out a negative gap, you lose money. Your NII goes down, correct? Agreed or not agreed? Is that understood? Hello?
Yes.
Yes,
or no?
yes, I'm right down.
Yes.
Yeah, okay. So basically, if interest rates go up, you have more liabilities than assets. So therefore, you pay more on your deposits. Therefore, if you have a negative gap, interest rates go up, you will have negative NII. So that is why now in that kind of scenario, what has the management said? Okay, look, we know that interest rates can go up or down, but we want to limit the risk to the bank through the movement in interest rates in that particular bucket. Okay, so we know you can make money going up. We know you can make money going down. We don't know which direction interest rates are going to go to. We don't know that. So we like to have within a variance of 5 to 10% positive gap or negative gap, so that either way, because depending on your position, if you have a positive gap, you can make money or you can lose money based on where interest rates go. If you have a negative gap, you can make money or lose money based on where interest rates go. To make sure the bank is in a position to absorb that kind of rate movement and at the same time maximize on its interest rate while managing risk of that rate movement, we have given you very specific parameters for you to work within for your risk management, for your trading purposes or management of your balance sheet. So within the 3-month bucket, we are comfortable with you doing 5 to 10% of 5% or 5% of positive or negative on your gap. Which means it's trying to tell you, look, we don't want you now. That guy who's sitting there managing the balance sheet could think, look, I think 10%, if interest rates go down in this kid situation, he's going to make a lot of money, right? As a totaler, he's going to make a lot of money because he has a negative gap of 10%. He has a negative gap, basically of 100. Interest rates go down, he's going to be paying less on his liabilities, and he's going to basically be paying more on his less on his assets as well. But the management's view is we want you to have against total assets or whatever it is, a 10%, 5% gap. That's it. go into 1 year, okay, we understand that the rate movement could be more and there's a longer period in that bucket, and things changing can be more rapid. So we are giving you a bigger limit. We don't mind you having like a 20% variance in that bucket. So the limit there is trying to make sure that you are staying within the risk parameters given to you by your board, your management, whoever you want to call it. And that's why it's important to manage that so that you know where your risks lie and what you should be doing within the scope.
So one question.
Sure.
For a bank, before you put gap limit, what are the things that you need to consider before you put the gap limit in a bank, like in a practical scenario?
Yeah, I agree. So basically, I told you, I think one of my lessons, I said we generally use PVBP as a present value for basis points to calculate this now, and say on DV1, this is the amount of limits we have, $5,000, $10,000, whatever it might be, and that is so that depends on a couple of things, right? Number one, the bank's own assets and liability mix. In other words, based on a trend analysis, you know exactly where. Not a couple of things, a few things. You know where your cash flows sits at, right? Number one. Number two, you also look at the requirements that you might have for the next few months as well, and then says, okay, fine, these are my general requirements I have to have. Number three, you have to also look at the requirement for your trading requirements. In other words, you might have a situation where your treasurer wants to buy more bonds because he feels interest rates are going to come down. Or he wants to divest some of his existing bonds because he feels interest rates are going to go up. Yeah. Or we feel that, forget the treasury bill side, that for some reason, we again on the interest rate side, you have a view of certain, liquidity issues or interest rate changes happening. So you want to issue debentures and you want to raise more money from the market, right? So in all those situations, when you do that and you're creating more assets or liabilities on a certain part of your cash flow, you're automatically at that point you need the limits to do that. So there are two aspects to it. One is the BAU requirement of the bank, which is based on the depositors mix and their liabilities mix and your forecast. And the second is on specific event-driven requirements that you might have, either from a trading perspective or from managing a liquidity perspective based on a view on interest rates. So it's not one exact science. So there could be an ALCO where you come and sit down and say, look, I'm paying deposits at 5%. I have 200 million liabilities, but I feel we need to raise more because interest rates are going to go up further. So this is a good time for us to go on a promotion and raise more liabilities at these current interest rates if we can, rather than trying to raise interest rates when interest rates are go. So let's try and increase our buckets in the 12 months, our limits in the 12 months, so that we can actually go out and take more deposits in.
Yeah. Is there anything like, suppose forecasted capital, we need to consider forecasted capital as well to set a limit prior to set a gap limit?
Yeah. So if you are losing capital, you have to replenish it from somewhere, right?
Yes.
If you are losing capital, why are you losing capital? There has to be a reason for you to lose capital, no? Or is it the thing is that your existing capital is not
No. I mean increase in capital, like forecasted capital, like always increase in like Basel and all.
Yes. So that means it's going to result in a cash flow, ultimately. It's going to be a cash flow, right? It's going to be you're going to create yourself into a, it's actually, it won't come as a liability. It will be a liability, but it will be a cash flow requirement, right? That you have coming in. If there's a cash flow that is coming into you on that birthday, and depends on how you're paying it. Are you paying interest for that capital? Are you going to pay? Is it, so for example, are you raising equity to get that capital? Are you raising it by way of like a debenture or a term financing thing? Not a financing, but a instrument like that. But yes, if you have a cash flow and you are paying, you have to put it there, because yes, definitely it's going to sit on your books and you have a payment that you make for that.
Okay, sir.
Okay. So this, so basically the movement of assets and liabilities is very simple. So you move, say for example, 50 over 1 year, 2, 3, and 50. Move 50 of 1 year assets to 3 to 6 months. So you take your one from here, you move it here, and move 100 of your 1 year to 6 to 12 months. Yeah. So after you do that, this is what your mix was. So what I'm trying to say is, we, in this case, to get within these limits, what they have done is they have resized their balance sheet, or they have restructured their asset and liability mix in terms of tenors, and come within the limits that have been mentioned there, as you can see. So now, how do you generally do this? Now, we said move 50 to 1 year, move 1 year to 6 months. How do you, in real life, how do you do this? I mean, you've taken a deposit from a client, you've already given people whatever. Now, what they're saying is you're not changing the overall mix of your balance sheet. Your overall over 1 year overall balance sheet size is the same. They're just shifting around the periods. 3 months to 1 year, 12 months to 6 months. So how do you practically do it? Can somebody give an example? How do you reposition your assets and liabilities without taking new assets and liabilities?
Maybe you want to increase the asset side. You go for promotional rates given at lower rate, like a bit lower rate to increase the assets portfolio. Like
No, but without
you need to increase
liabilities, how do you do it without? So in other words, what they have done here, if you look at this particular example, you move 50 of your assets to 3 to 6 months, move 100 of your assets to move 50 of over 1 year assets to 3 to 6 months, move 100 of your 1 year assets to 6 to 12 months. How do you move it like that? I mean, you can do it on the spreadsheet, but in reality, how do you do it?
You need to specific to whatever the target period, then give the like when it, as a loan, when you take as an example, like if you take loan.
Okay, so you take a loan, you put a new loan for 6 months. Okay, fine. What
Yes.
about the loan? What do you do with that? You have a loan that's over 2 years that they have moved into the 1 year bucket, right? Or 3 month bucket. What do you do to that over 2 year loan that you already have? Look at the question, the thing here. They said here, move 50 of your over 1 year assets, over 1 year loan to the 3 months. How can you move that into 3 months? What do you do for that? In reality, in practical terms. I mean, I can come and tell you, look, move your 2 year assets into 3 months. What am I going to actually do about it? How am I going to do it? So I'll give you one example. If you have bought a 2-year bond or 3-year bond, right, and you have now breached limits, yeah, you can decide to sell your 3-year bond or 2-year bond or whatever it is, 2.5-year bond, and invest in a 3-month treasury bill. So overall, you sell 50 million bonds and you buy 50 million treasury bills. Does that alter the asset mix? Yeah, it does, right? You still have an asset, 50 million, but you moved it from the 2.5 years to a 3 month. So you've done this. First one. Yeah. So in other words, you can ask somebody who you lend money to, where you lend over 1 year. Maybe you can ask whether they want to repay that debt back to you for whatever reason, and try and sort of restructure that loan to a 3-month loan. Depends. The treasury bill option is better because you can actually go out and do that in the market without disrupting a client loan. But at the end of the day, if you are supposed to do it without creating any new assets or liabilities within the current mix that you have, it always comes down to restructuring the mix of your thing. So often this can be done with tradable securities like the corporate debt, corporate commercial paper, maybe listed. There are no listed debentures, but basically things like treasury bills and so on.
So one question now. You say you can sell treasury bond.
Yeah.
Suppose we can do like in order to we can get into agreement with a particular counterparty, like I am going to sell my bond, but 3 months time I am going to buy back the same bond as well. Something like that. Could in the market can we get the agreement?
So basically, if you sell a bond and you buy, you can't do that. You can't do it. There aren't agreements like that, because what happens is a sale is an outright sale. Yeah. So if you are doing that, if you are doing that, it comes to something like a repo agreement, more than a bond where you are selling it with a buyback agreement. So it's a sell and buyback. So in other words, actually what you're doing is a repo. You're selling your bond now and agreeing to buy it back. So in other words, you're funding you are lending your money. So you're doing what we call a reverse repo. You're lending your money for 3 months against that security, effectively. So it's not an outright sale. You can do it by virtue of a reverse repo.
But by doing so, will we be able to restructure the balance sheet?
If you are doing repos, yes, because then technically that will be a 3-month asset that you have created. Because your liabilities or assets are only for 3 months in that.
Okay.
Correct.
Yes, and yes. Yeah.
Sorry.
Okay. Yes. Okay. Sir. Thanks.
So again,
but outright we can't sell this thing and we can't outright buy it, no?
No, it's not. That's why the repos are there, because when you sell or buy a treasury bill, it's a bill of exchange, and you're basically owning or getting rid of a asset that you own, or you're buying an asset. Once you have it in your portfolio, it forms part of your overall invested portfolio. Now, what you do with that subsequently is totally up to you, in terms of whether you want to hold on to it as a held to maturity book, or you want to divest it from a trading perspective. But it's all up to you, right? Now, but it's an outright purchase or sale or something. That's it. So the only other way is where, like you said, people want to buy a bond or bill, but they don't want to necessarily sell it. We'll say you bought a 2 years, but now you have a problem. You need to fund that 2-year bond, right? But you don't want to sell it. You want to have that asset on your books. Yeah. So you keep that in a portfolio, and then you create a liability for 3 months for yourself. Yeah. Where you basically sell it and buy it back. So in other words, when you sell it, you're getting rid of it for 3 months. But when it comes back, it sits back on your assets for the remaining period. You can't sell it for the period that you have repoed it, but once it's back, it's yours. If you want to sell it at that point, you can. So you mark that asset for your repurchase purposes. Is that clear?
Yes, sir. That's clear.
Okay, so this second, the slide 49 is basically another example of that. Like I said, it says here sell over 201 year asset and pay 50, 60 of the liabilities for. So basically, just going off and showing you exactly another example of what we discussed. The next thing is altering the gap if it's an off-balance sheet item. So what are the off-balance sheet items we're talking about here? It is basically something like a interest rate swap, where you either pay or receive fixed. In this case, you're paying fixed, so it's basically like a liability where you're borrowing for a certain period and paying a fixed interest rate for that. And your floating leg will be where you're paying the 3-month SLIBOR for this. Amount is 150 million, maturity is 3 years for this example. So now let's look at that. We have the gap of 100, 50 and 200. So negative gaps in that beginning period. I'm on slide 52. And then we basically calculate to see what the net impact of the swap is for the on the overall position. So where did that 150 come from? It basically comes from this 150 here. Right? It basically says the amount of the swap, that is the notional of the swap, the value of the swap. So the gap changes on because you created a liability for 150 and your net gap position before you started off is 100. Sorry, your gap position before you started off is then minus 100. So your net gap because of the liability you created becomes 50 there, positive. And the cumulative is also 50 in that case. So then the assets against liability gap, right? So then what happens here? You now have a 5% cumulative. This is 5% comes from 50 divided by your total assets. Where is your total assets here? 5%. Where is your total assets? It would be based on this one, I think. So total assets against total assets is 5%. And against your total liabilities is assets under 1 year will be 20% minus. So what you have done here is to alter your gap, you use the interest rate swap. So what is the interest rate swap? Let's start with the basics. What's the interest rate swap first? What is the interest rate swap? Interest rate swap is where you swap your certain interest rate payments from floating to fixed. So in other words, or fixed to floating. So in other words, let's look at an example, right? You have a loan on your books where you have given out, you have fixed your rates for this client at 10%. You're basically receiving 10% every 6 months, but your rates are fixed. It doesn't change with the interest rate movement. So it's a fixed rate loan. Now suddenly you expect interest rates to go up. You expect interest rates to go to 15%. Now that asset is fixed at 10. Now what can you do? You can't get out of the contract with the client. That's a fixed term contract. You agree, the client doesn't want to. You're happy, he's happy to keep it. Now, by keeping that, and if your interest rate expectation is that it will go to 15%, are you going to lose money on that? Forget the gap for a second. Just look at that particular loan. Are you going to lose money on that loan? Yes or no? Are you going to lose money on that loan? Yes or no? If you have a loan that's getting you 10% and you expect interest rate to go to 15%, are you going to lose money on that loan if interest rates go up? Yes or no?
No.
You will lose money on the loan, because if you have lent at 10%, right, and you have fixed your rates, and tomorrow the interest rates go to 15%, yeah, that means what you could have lent at 10, now you can lend at 15. So yes, argument could be I've lent at 10, I borrowed at 8% at the time of lending, therefore I'm still going to make my 2%. Agreed. But if you have lent at 10% and you have borrowed floating, and now the rate goes to 15% on your liabilities, it means that you have asset at 10% and your liabilities or deposits at 15. So you're going to lose money there. Even if it's not the actual case, right? The fact that you have opportunity lost on your books, right, in itself is a negative for you, right? So I'll give you an example, right? Just what I just mentioned. You have an asset which is a 5-year loan, right, which you have lent at 10%. Now interest rates go to 15%. So your liabilities for this loan you may have borrowed for 5 years. Your liabilities for 5 years you may have borrowed for at 8. So I agree with you. You don't lose money because you make a 2% positive for you. Yeah. Fine. Good. Now suddenly interest rates go up to 15%. Now this is still at 8. If you have fixed this rate, it's fine. You're making your 2%. You're happy. Now, if you have not fixed this 8%, now this 8% is now 15%. Now, are you losing money or not? Are you losing money or not? You are, right? Because now you're receiving 10. You're receiving 10 and you're paying 15. You're negative of 5%. So now if you know this is going to happen, what do you want to do? You want to quickly move away from this fixed rate to a floating rate. So what do? You swap your pay fixed leg into a floating, where you go and tell somebody, look, I want to do a swap with you, right? And I want to pay you fixed, you pay that guy fixed, and I want to receive floating. So then you convert your fixed asset here. Immediately somebody is going to come and say, okay, fine, we'll pay you 10%. You pay your guy 10%, and you will basically receive from us at 15%. So in other words, without disrupting your client's loan, you do this as an off-balance sheet product. It's a derivative where you go and pay fixed or whatever and change your interest payments only into a paid to a fixed to play floating or floating to fixed. That way, you have your interest rate risk managed in the best way you feel fit. So, for example, I'll give you an example now. Currently, US interest rates are at historic lows. There are people who might want to fix their dollar interest rates because they expect in the next 10 years, dollar interest rates will pick up. So they might come and say, look, 5 years, I want to swap my interest rate, which is floating against LIBOR, into a fixed rate. Yeah. And the bank will say, okay, fine, we'll quote you X rate for that. And the client says, okay, fine, let me take that rate. So, but his loans could be anywhere, at any place, but he's only switching his fixed to floating or floating to fixed. That way, managing his interest rate risk. So, by doing that, and then putting it into this gap analysis also, you then have a situation where, remember what I told you earlier, why does the management have limits on gaps? So that the rate sensitivity can be managed, that you have a limit on rate sensitivity. So by doing this, you are actually managing the sensitivity of rates on your overall assets and liability book. Although the actual assets and liabilities could be different, you know you have a swap for a certain notional at a certain time that protects you from adverse movements in interest rates because it's fixed or floating or whatever it is at that point in time. Is that correct? Is that understood?
Yes, sir.
Okay, great. So I'll just go through these questions quickly and then we'll take a break. Sorry, it took a bit of time. I wanted to finish this before the break. And then for the last session, I'm not going to touch on duration too much because I think Nishanta has already done it. We'll have a quick refresh of that very quickly, and then that will be it for the next presentation. So for the moment, I'll just do these questions and we'll stop for 15 minutes. And then probably another 1 hour on the duration slightly just to go over that presentation. And it may answer the questions you all might have. But let's finish this off. The statements below, whether the following are true or false. In slotting an amortizing asset into a gap report, we should include the total amount of cash flows received in each period. Second one, we should be concerned about the remaining maturity and not the original maturity of the deal. Are these statements true? In slotting and amortizing asset into a gap report, we should include the total amount of cash flow received in each period. Is that correct? Remember the example where we did the 10,000. Here, when slotting, what did we put into the gap report? If it's an amortizing asset, right? So remember, we are trying to figure out when we are slotting an amortizing asset. What are the, now you know the repayment for this was 3,155, that includes interest. Yeah. Now, what did we actually put into the gap report? We put only the principal, right? So to try and figure out exactly for that particular amount, when are we getting the principal back on these loans, basically? We ignore the interest part of it. So for this particular question, and that's a bit of a limitation on it. I'm not saying it's perfect, but in the purpose of keeping it consistent, when you are looking at it from an asset perspective, you have to put the amortize. You need the interest rate to figure out what that payment is. But once you do that, you basically slot in the principal of that amortizing into that. So whether it is interest paid monthly, yearly, or at maturity, that has an impact on the principal amount that you basically take in. And then the second question, so the answer to that is yes, you take you don't take the total cash amount. You take the, when you say total cash flow, you take the one without the interest. You only take the principal amount. Then we should be concerned about the remaining maturity and not the original maturity of an asset. Is that correct?
Yes, correct.
That's correct, exactly. The second one, the cumulative gap as a percentage of the total assets is less than the cumulative gap as a percentage of interest earning assets. Cumulative gap as a percentage of total assets is less than the cumulative gap as a percentage of interest earning assets. Is that true or false? So, for example, okay, so we'll put it on paper, easy to understand. So, total assets, we say is 100. Interest earning assets, yeah, could be say 70. Interest earning assets, 70. Okay, and then the gap is 50. Doesn't matter, plus or minus, right? Yeah. So then, what is it saying? Cumulative gap as a percentage of total assets. So total assets, cumulative gap. What's the percentage? 50%. is less than the cumulative gain as a percent of interest earning. Interest earning assets, 750. The percentage there. It is basically, it says 75% or something, right? So what's the answer there? The cumulative gap as a percentage of interest earning assets is more than what it is for total assets, because invariably your total assets are going to be bigger than your interest earning assets. So because of this, this is going to be a higher percentage than that. Is that understood? So that thing is wrong, right? No, it's correct. It's less than the cumulative. Yeah, correct. It's correct. Is that understood? It's clear.
So this answer, in the sample, this gap is assuming 50%. Is it?
I'm sorry, I didn't understand what you said. Tell me again.
In this example, the gap you take like 50, no? That is the assumption. Or in the sum, what you
This
calculate?
one? Yeah.
Not that gap.
I just took an example, yes.
Yeah, okay. Yes.
Just to show you all the calculation. That's it. Because the total assets are going to be definitely more than interest-bearing assets, right? So because of that, you're going to have a lower percentage of from the gap there. If the gap is positive, interest rates decline, interest income declines. Is that correct? If the gap is positive, that means you have more assets than liabilities. Interest rates come down, interest income declines. Is that right or wrong?
That is right.
Correct. Gap report is a flow statement. Right or wrong?
What do you mean by flow statement? Like,
flow statement is cash flow statement. Yeah, it is, right? End of the day, it shows you what your cash flows are at. So it is correct.
Yeah.
A liability sensitive bank has assets that reprice slower than liabilities. Is that correct? What's a liability sensitive bank? So we used a different term for positive and negative. So when you say liability sensitive, what kind of gap is that?
negative gap.
Exactly. And then when you say negative gap, what do you have there?
Liability bank has assets that reprice slower than liability.
You have more liabilities more than assets, correct?
Yes.
Your liability sensitive means you have more liabilities than assets, correct?
Yeah. Yeah. You may lend long term.
You have lent long term, which means your liabilities get repriced faster than assets, correct?
Yes.
Is that right or wrong?
Liability bank assets. Wrong.
Sorry?
Wrong.
Okay. This question here says, what's this say? A liability sensitive bank has assets that reprice slower than liabilities. So that is assets that reprice slower than liabilities. So that means liabilities are repricing faster. So let's go back. That's correct, right? So if you look at this thing here, because I'll take you back to that thing, the grid we had. Here you go. Slide number 6. As you can see, if you are a liability sensitive bank, you have long-term assets funded with short-term liabilities, right? And you have a negative gap, which basically means your liabilities get repriced faster than your assets, right? The question here is, the liability sensitive bank has assets that reprice slower than liabilities. In other words, the liabilities reprice faster, which is correct, right? So then that is correct. It's just a confusing way of putting the question. So what you need to understand is when it's liability sensitive, your liabilities will get repriced faster. than your assets. Simple as that. Okay, a liability-sensitive bank will improve. NII will improve from a declining interest rate. So obviously we've discussed it in detail. So is this just simply looking at it? Is that correct? Without looking at anything else, what we just said, a liability-sensitive bank, which means their liabilities get repriced faster than assets. When interest rates go down, will it improve NII?
Yes, correct.
That's correct. Last question, assets repricing before liabilities means a bank with a negative gap, right or wrong? Assets repricing before liabilities means a bank with a negative gap, right or wrong?
That is wrong. It is a positive gap.
Correct. It's the same as before. Basically, it's a negative gap means it's a liability-sensitive bank. So, which means their liabilities gets repriced better, faster than assets. Okay, we are done with that. Any questions before we take a quick break?
So here this liability sensitive in the sense like you have lend long term,
Yep.
but borrow short term, something like that.
Correct. Exactly.
Liability sensitive.
That's exactly right. So what you're saying is you have lent long term, and you have short term deposits, liabilities, right? Which basically then means
Okay.
that you are sensitive to your interest rate movements in the short term. If interest rates go down, you'll make money. If interest rates go up, you can lose money. Yeah.
Okay.
Now, also you have to also realize by each bucket that can change, right? So when you say long term, short term, then NII, like we said, does not come simplistically just because of a rate movement like that. Yeah. So
that
you have to understand that as well, right? So yes, if you have a majority of your assets in the long term, and then you have, depends on how much of your assets are there as well. So for example, if you have 100 million in assets and then you have 200 million in liabilities, right, in the short term, then definitely interest rates going down, you're going to make money because you have more liabilities. But remember, your short-term liabilities are only giving you that benefit for 3 months. If interest rates go up the next month, you are open again to it. Unless you do an interest rate swap and fix your rates for the deposit for the remaining period of the loan. So that's why it's a dynamic process. Okay. Right. Okay. So we'll have a quick break, maybe 10-15 minutes. And then we'll touch on duration very quickly. You all have done duration, right? Like I said, I think Nishant told me that you all have done it. This one is again covering a bit of it, but I'll just touch on it for about an hour and then we can call it a day after that. Okay? All right, we'll come out again about 10 minutes time, yeah? 11:15, you say?
okay, sir.
Okay, thank you. Right, let's start off. So we are going to touch on something called duration here. And why are we touching on duration in this particular area? Because I think Nishant would have covered it when he did fixed income for you. Duration basically is also a basis of understanding the volume and of risk that you have. And again, it comes down to interest rates and figuring out the sensitivity of interest rates on the portfolio that you have based on the timing of those cash flows and the timing of the particular portfolio that you have. Can you hear me? First, sir, sorry. I don't know whether everybody's in.
Yes, sir. Yeah.
Okay, great. So let's get into it. So Right. Okay. What is duration? What is duration? What is duration? When I say the meaning of the word duration, if I say the duration of that lecture was 30 minutes, what did I say? What am I talking about? What is duration? It's a simple question. What is duration? Yeah, duration is time. Basically, how long? So if you have 0 and this is 1 year, nothing in between, the duration is 1 year. If you buy a security now, that's maturing in a year's time, the duration of the security is 1 year. Now, where it gets complicated is, if you get a cash flow for that security in 6 months' time, and also paid. So you have 100 here, 50 is paid here, and 50 is paid here. Now, from a average, from a maturity of security, yes, it's in maturity 1. The whole thing ends in 1. Agreed. But in reality, is your risk of 100 all the way here, or has it been now averaged out? What has happened here? Has your duration increased or decreased? The duration for the bond is the same. It's still 1 year in the sense of the timing of the bond is 1 year. We know that. It's fixed, right? But in reality, your risk in terms of receiving your money back, is it less now or more? Or more now? If you get something in between. You have given somebody a loan and he tells you, I'll pay you 50 in 6 months, I'll pay you 15 in 1 year. Is your actual risk on the loan 1 year or less than a year? Is your actual timing of receiving that less than a year or more than a year? Or a year? Less, because ultimately your risk is staggered over a year. So although you have it up to a year, you're receiving, so it's actually so. When you look at duration, duration is considered the average maturity of something. So if it's a 0 coupon in principle at end, yes, everything is here, your risk is there. But now your average duration is less in this because you're getting half of it beforehand. So in computing, we are considering both the timing and how much. So for example, if you were getting, so in this case, your duration is not 1 year, it will be probably somewhere between 1 year, so it will be somewhere here. That's your duration, actual duration, right? Now, if you are considering it at, if you are getting not 50 here, you are getting only 10 here. Earlier, your duration was, we say, here. Now, what is your duration? Is it here or is it this way or this way? Is it higher or lower, the duration? Now, you're getting out of the 100, you're getting 10, and then you're getting 90 here. Okay? Now what is your duration? Is it more to this side or more to this side? Is it getting more or is it getting less? You're getting only 10 now. Earlier you're getting 50. That means you're getting 90 at the end. As your duration increased because this 50 now became 10, and this 50, the 50 that was here now has increased to 90. What has happened? Has your duration gone up or gone down? The duration has increased, right? Because earlier you were getting 50, so it was less. Now you are getting only 10. That means you're back to almost having 90 at the getting 90 at the end. Yeah, your duration was somewhere here. Now it's gone back closer to this. It's almost close to a 1 year maturity now. So what duration is doing, what you're trying to get from duration is trying to calculate based on the cash flows and how much of cash flows and when you're getting those cash flows, what the exact timing or the maturity of that particular security is. To do that, of course, you have to use the present value terms. I'm giving you the simple cash flows, but in order to figure out the duration at time 0, here, you need to understand your cash flows, and based on the cash flows, come back here, right, and say, okay, this is a 1 year bond, but given the cash flows that we are getting, it's actually 6 months. The PV of all that is 6 months. So the actual duration is only 6 months. Is that clear? If it's not, please tell me. Okay. Now, why do we need to know duration? Again, comes down to one simple thing. By knowing the duration of what you own, you know your actual, you can measure your actual risk with movements in interest rates. If you are looking at a 1 year bond and saying, look, my risk is in 1 year, so if interest rates go up or down in 1 year, I have this risk. But in reality, you're getting cash flows in between. That's not correct. It's not actually 1 year there. You're not getting your whole principal back in 1 year. You're getting your principal back in between. So in other words, by looking at this, you can figure out what your actual timing or what the actual period of it, and which helps you then figure out if interest rates move and then the price of the bond or whatever security moves along with the interest rate, right? Then you can figure out for yourself what the impact of that price movement is in reality to the actual portfolio you have. So you need to know the right timing so that you figure it out. So if you look at the formula in slide number 8, you see there, what does it say? What we just discussed, right? You take all the cash flows, this T, right? And then you basically look at it, present value of each of those cash flows for that period. And then you take the sum, you divide that by the sum of the present value of the overall cash flows, right? So what are you trying to do there? You're looking at, right? You're looking at for each of these cash flows that you are receiving, okay, against your total cash flows, right? What is the time duration for that? You'll understand more when we do the next example. Okay, so we'll get to that. So the modified duration is what I discussed about. Once you have figured out what the duration is, you need to figure out what a movement in the price or the yield of a maturity, what kind of impact that has on the price of this bond. So in other words, duration is a measure of time, Modified duration will tell you, okay, based on that duration, if interest rates change by X amount, right? This is the impact of that change on the price of the bond that I have. Let's go into example. You'll get it more. So, step 1. Calculate the timing and magnitude of the cash flows associated with the instrument. Find the present value of each cash flow. Find the total value of all the PVs. Yeah. Find the time-weighted PV of all cash flows. Find the total time-weighted cash PVs of that, right? Divide the total by the total in step 2. So let's do the exact thing without going through all that. With bonds with more than one coupon for a year, you present value all the coupons basically. Okay, now let's go into example, might be easier. Right, look at this one here. Now, slide number 14, bond number 1, 5-year bond. 5-year bond. Yeah, the yield is 12%. So the bond is earning or paying an interest rate of yield to maturity of 12%. Yeah. Now it's a 5-year bond, right? And the coupon is 12%. Does it say annually? Yeah, annually 12%. So what is it saying here? You have 5 years. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. That's the 5th year, you get your principal back. So each year, your coupon is 12%. 12, 12, 12, and 12. Okay. Now, what is the condition here? A 5-year 12% coupon bond selling at 100. So at par, meaning you're buying, it's 100 face value, it's 100, and you're buying it at 100 as well. So there is no difference between the price you're paying for the bond and the price. So it's that par. So if the bond is 100, today you're paying 100 for it and you'll get 100 back. So all the interest is paid to you. That's the only cash flow, additional cash flow you're going to get. There's no, you're not paying 90 for a 100 bond, nothing like that, right? Now, what's happening here? What is the actual duration of this bond? Because you're receiving your coupons every 12% every year, what is happening to this bond? Your actual cash flows are not all coming here. It's staggered. Yeah. Because it's staggered over this period, your duration is actually 4.04. That is your duration on the bond. Because if you add in all the present values of all these cash flows that you're getting on the bond over a 5-year period and bring it all up here, the 5-year bond, which you have on your books as a 5-year instrument, because you're getting paid interest over a period of time, the actual time period of that bond on your books is actually 4 year. It's a 4-year instrument. Is that clear? If it's not, please tell me. Without, you can look at the formula later. For the moment, just get the concept. Is that clear? Yes or no?
Yes,
Yes or
yes.
no? Clear, right? Okay.
Yes. Yes.
Now, if you take it, now look at the same bond. Second bond. Look at the second bond. That bond, the coupon is 10%.
Well, can you write it down bit below? Like we can't see this.
Can't see that. Okay, thank you for telling me.
Yeah.
You can't see that. No, okay. So, right, we'll take the second bond. The coupon is now, first one, the coupon was 12. Can you see that? So the first one was 12%, right? Now the second bond, the coupon is 10%. Is that correct? Now, effectively, what is happening now? Are you getting paid more every year or less on the coupon?
Same.
You're getting less.
12, but
You're getting less. 12 becomes 10, right?
Yeah.
So when you get paid less, what happens to duration? You're getting less money now upfront. So your duration is going higher. If you look at the duration there, it's 4.17 years. So in other words, the lower the coupon you get, yeah, the higher the duration. Same way, if you look at the third bond, it goes down to 6%. Okay, when it goes to 6%, what is happening there? The duration is then going up to 4.47. In other words, you're getting 6%, which is less than the 12 and 10% coupon, and your duration is increasing. Is that clear? So these are the first three bonds we discussed. 5-year bond, 12% coupon, 100 par. 5-year bond, 10% coupon, 100 par. And then there's a 10-year bond selling at 100 par, which we have not given the example here for. But basically, the basic concept is if you are getting a coupon payment in between, yeah, your bond is going to basically give you a higher, lower duration, but it will go by how much that coupon is. Higher the coupon, lower the duration. Lower the coupon, higher the duration. No coupon means it's the full duration, which is basically if there were no coupons in between, it will be the full 5 years of the bond will be the duration. Is that okay? Understood? Okay. Now the second part of that question, the second part, bond number 4, 5, and 6, right? In that, it's a bit tricky. Now the coupon remains the same here, 6%. So ideally, it should be whatever 448. But the yield to maturity, basically the value at which you value each of those cash flows. So remember, when you're calculating duration, you're taking each of these coupons and you're taking it as a present value, right? You're calculating it as a PV to get to this. Now, in the first example, 1, 2, 3 bonds, where the yield to maturity and the coupon are the same, right? It basically, you're working on a basis of that. So now what have they done there? In that one, if you look at 4, 5, 6 bond in slide 14, you'll see when the yield to maturity is 6% and the yield is 6%, which is the fifth number 5, the duration is 4.47. That's what we discussed on top. Now you change the yield to maturity. You change the rate at which you value each of these coupons. You make it 7% instead of 6%. When you make it 7%, you PV, your duration, your yield to maturity has gone up, which basically means the duration has got down. Because now you're present valuing this with a higher yield, right? Which means you're reducing the duration. If you bring the duration, if you bring the yield to maturity down to 5%, which is basically the slide on row number 6, your duration goes up. So basic concept is this. There are coupons, they pay you back, therefore your maturity is less than what the original maturity is. Also, the rate, the yield at which you PV this back to zero, that has an impact on how much the bond is valued at as well. So in other words, if the yield to maturity goes up, your duration will come coming down. Yeah. If your yield to maturity keeps coming down, your duration will basically start to climb. So the lower the yield, greater the duration. Is that understood? So why is this important to us? If a bank buys a 5-year bond, has coupons coming every 6 months or whatever you want to call it, suddenly that's a coupon that they're paying on the value of the bond, right? Now that coupon, you take all those coupon payments in, fine, right? Now you have the yield to maturity, which is the market rate at which the bond is trading at, higher or lower. Suddenly you bought this at par, your coupons are 12, that coupon doesn't change, it always remains the same. But your yield to maturity changes. Your yield to maturity basically goes up or down or whatever. Yield to maturity Hello. Hello, can you hear me?
Yes, sir. Yes,
Sorry,
we can
we
hear
are
you.
losing current today, so in current went. So let me just go back to that. Okay, so what I was saying was basically what I was trying to say was if the yields on a bond change. So what is a yield? What is a coupon? Coupon is what you get paid on a semi-annual or annual basis from the bond itself, on the face value of the bond, and the yield is what is the market rate of the bond, basically. So when you buy a bond, let's say 10%, right? And then at that point in time, when you calculate the duration, you get a certain value that comes as. So 5-year bond, in this case, the yield is 6%, and the coupon is also 6%. Then your duration is 4.47, right? Suddenly the yield goes down to 5%. Yeah. So then at that point in time, when you value the same bond for the remaining duration of remaining cash flows that you have, that 5% that you have brings down, takes up the duration of the bond to 4.48. Because now, from that point onwards, the cash flows you're using, the yield to maturity they're using to value the remaining cash flows is no longer 6%. The YTM that you're using is 5%. If the yield to market has gone up, then basically the duration comes down, right? So why is that important? Because what I told you earlier, in terms of valuing these bonds, you need to figure out exactly where your risks lie and what exactly is your exact duration of the bond. Now, based on that duration, right, you figure out, here's another example of that. So for example, next slide, 15, 2-year bond, coupon 6%, yield to maturity 6%, 1.94. Yeah, 5-year bond, 6%, 6%, 4.47. 10-year bond, same, right? So if that yield to maturity changes, that bond duration will change for the residual period. So higher the maturity, greater the duration. Lower the maturity, lower the duration. So if it's a zero coupon bond, meaning you're not getting anything till the end, right? Your duration will be higher because obviously you're not getting anything in between. But you still have a bit of duration because ultimately you take it as to when exactly you're going to get it. So for example, zero coupon bond, you will have the whole duration of the bond will be the 5 years. Because ultimately you're not getting any coupons in between. So that basically means here you bring face value straight away here, there are no coupons paid in between. So if you have a coupon that is low, right, coupon rate that is low, right, and basically you take your risk factors in. So let's look at this. Your coupon rate and your maturity. So let's look at the coupon rate first. You have a coupon rate coming in. So is your risk higher or lower? Forget what the rate is. You have a coupon coming in, right? So if the coupon rate is low, is your risk high or low? Sorry, if the coupon rate is, depending on the coupon rate, if the coupon rate is low, you have a higher risk and a longer duration. If the coupon rate is high, you have a lower risk and a shorter duration. You all understand that? Just take it for a second. If the coupon rate is low, you have a higher risk and a longer duration. If the coupon rate is high, you have a lower risk and a shorter duration. Is that clear? Why is that? It's a simple concept. Because ultimately, if you are getting paid back something more, which is the high coupon rate, yeah, that means your risk is less. Your repayment is faster. Yeah, I lend somebody money, and instead of paying me 10 rupees every month, he's paying me 20 rupees every month. So my risk is low because I'm getting my money faster. Yeah. And then my duration is less also because he's giving it faster than, if it pays me 10 months, 10 rupees into 15 months, and then, 20 months, and he's paying me 20 rupees into 1 year, the actual term I'm actually paying is shorter, right? So I'm having a lower risk, right? And if the maturity, the second one, if the maturity is longer, my risk is higher and the duration is longer. If the maturity is lesser, my risk is lower and my duration is lower. And then last thing what we just learned, if the yield to maturity is low, my risk is high because the duration increases. And if the yield to maturity is high, my risk is low because the duration is shorter. So in other words, if I buy a bond with a high coupon and at a high yield to maturity, yeah, my risk is low. Is that clear or not? I'm going a bit fast because I know you guys have done this, but please ask questions if it's not clear. So what I'm going to do is I know you all have done this for bonds also. So I'm going to just touch on the basis points and I'm going to stop there. I'm not going to go into convexity. But let's just do the basis point thing. So what is the basis point? It's basically 1/100th of a percent, 1%. So 1 basis point is 0.01 basically. Yeah. So also called a dollar value of 0.1. So 1 basis point is 100 basis points is 1%. So 1 basis point is 1/100th of 1% basically. Yeah. So 1/100th of that basically. So 1 basis point is used to calculate. It's also called a dollar value. It's called DV1. That's why it's called dollar value 0.1. Yeah. So DV1 represents for 1 basis point a value of a certain asset or portfolio. For 1 basis point, what exactly will be the impact on that particular portfolio? That's what we call present value for a basis point. It's called DV1, whatever it might be. So it gives you a measure in dollar terms or whatever of the impact of a basis point movement in interest rates. Yeah. So conceptually, it is duration because you're taking the time weighted cash flows and you're looking at the impact of yield. So it's basically modified duration and modified by the position you have. So give you an example. Somebody has a portfolio of 12 million rupees. The modified duration of it is 3.12, right? So what is the impact in dollar terms of that particular 1% move in interest rate? So in other words, what is it saying? The modified duration, what we're saying is that for 1 basis point move, the portfolio is at a 3.12% in terms of time weighted average of that particular portfolio. So a 12 million portfolio with a duration, modified duration, in other words, a DV1 of 3.12, right? What is the present value of that portfolio? What are you trying to do there? You're looking at the percentage, which is 3.12%, which is the modified duration of that 3.12. So you take 12. What is the modified duration? Modified duration calculates for you for 1 basis point move in a particular portfolio. Once you know the duration, so we say the duration on that is for whatever, 4 years or whatever. Modified duration, which is 3.1, is calculated based on what the impact of 1%, one basis point move on that particular portfolio is. So you have 12 million, which is the value of the portfolio. You have modified duration, which is 3.12%, and you have 1 basis point move. So you are trying to calculate what the dollar value of or rupee value of the move is. Now here, 3.12% is 3.12 over 100. And then you're trying to see, okay, this is it. When you solve for this, you get a rupee figure that if the interest rates, the present value for the basis points, right? The basis point present value is 3,742. So what it is say? What is it saying? If interest rates move by 1 basis points, this 12 million portfolio will move 3,744 rupees. If interest rates move on by 1 basis point, this portfolio, the value of this portfolio will change higher or lower by 3,744 rupees. Let's look at the second one, you get more clear on that. So if you look at a portfolio of 100 million rupees and the dollar value, the DV1 of that portfolio is 67,000 rupees. So in other words, it's giving you the value, right? It's telling you now a 100 million portfolio, the dollar value DV1 is 67,000 rupees. So this is DV1. Okay. What is the modified due? So it's telling you to calculate, okay, what is the impact of what to get you that. Based on that, you reverse engineer it. So you have now 67,000, which is the earlier what we calculated in the previous sum. You have the portfolio value, which is 100 million. Yeah. And what do? You have to calculate what the modified duration is. We don't know what this is. We know that's 100 over whatever that is, because that's a percentage. And we know for 1 basis point, this 67,000 represents for a movement of 1 basis point, so 1%, 5%. Now, what do you got to do here? You got to solve for this equation. And once you solve for it, you will get an answer of 6.7%, right? What is the 6.7%? What is the 6.7%? 6.7% is telling you, based on your portfolio duration, if there is a 1% move in interest rates, your portfolio will move by 6.7%. What you did earlier was find out what the dollar is. So now you know what it is. So 6.7% of this will tell you exactly what the dollar value of that is basically. On day 1. If you look at the next slide, number 22, if you look at a bond that is 5 years with a coupon of 10%, modified duration is 3.79. How is that? Interest rates go up 1%. Then the offer. Oh, right. It's a regular pain. Then pay that. Presentation is here. Almost done. The presentation. So what do I go there? Presentation. Presentation. Okay. Right. So if you consider a bond of 10% in 5 years and the coupon of 10%, the modified duration has been given as 3.79. So basically what they're saying is for 1% in yield, the duration changes of this bond modified duration is 3.75, right? So now interest rate go up 1%. Now what is the change or what is the new value of the bond? you look at 1%, interest rates go up, right? The change in value is that the 3.79% duration interest rates have gone up, so the duration has come down, right? So which basically means if it's bought at par, now the new price would be yield going up means price coming down. Goes to 96, goes up 2%. The duration basically is 3.79 into 2. Yeah. So that basically means the price comes down this much. Yields come up, go up, go down 1%, duration will go up. That means the price will go up, etc., etc. So why we are looking at this, why we are looking at the duration and then also the modified duration, is basically trying to understand if interest rates were to fluctuate up and down, what the impact on the value of the portfolio will be on a day-to-day basis. So this is not a theoretical exercise just to understand the timing differences. It is also to understand the value of the portfolio you have, so that if you need to exit or put on new assets or whatever, then what is your actual price of those assets you hold up based on the duration of its current duration. Okay, so that's slide 23 has the same thing with different years. Okay, and then we have convexity basically, which touches on the changes in the different parts of the curve and how that impacts duration, because it's not linear throughout the period. Okay, so I'll stop there for today. Okay, can you tell me exactly how far into duration and convexity you all have done? For fixed income? Hello? Can you hear me?
Yes, sir.
Okay, you all have done duration and convexity before, right?
Yeah. Yes.
Okay. All right, so let me stop there. And if you need to touch on this subject later on, because I need to understand exactly how far you all have done in it before I go into convexity, I'll talk to Nishant also. And maybe he will touch on it as part of his fixed income thing, because it's more relevant there. We use it as part of ALM because most of the ALM desk also used fixed income products for their portfolio. So on that basis, you also have, that's why it's touched here again. But in reality, most of the fixed income trading desks are the ones, or the fixed income portfolios are the ones who use theory a lot into their day-to-day trading activities. So let me stop there. I will most likely see you all only during the revision times, and Nishanta will be taking the class next week. We will look to see whether we can sort of plug in any of the gaps that there are, and we will probably look at giving you all guys an assignment after Nishanta has finished his last bits of his area. Are there any questions from the ALM side that we have touched so far? Anything else that you want to clarify? Okay. If not, thank you very much. I will hopefully see you all soon. Hopefully, I will see you all soon in class. Let's see. At least for the revision classes, let's try and see whether we can get you all into class. But if not, we will continue like this for the rest of the course. Thank you very much. That is my main course area is done, but I will be doing the revision with Nishanta later on. I will see you all again afterwards. If there are no other questions, thank you very much for your time.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you. Thank you.
Sir, one particular question can I ask?
Yeah, please go ahead. Yes, please do.
Yeah, this is like just want to know, get an idea. Now we can do like out of this, we can do this reverse repos, no? Like
Yeah.
reverse repo in the sense customer might have treasury bill and
Yeah.
he want to give it as a collateral and he will give the loan, get
That's
the
right.
loan from the bank.
Correct. Yes.
Then the bank's income could be like the income can be it's the number of days you held that the particular bill and
Yeah.
the whatever the coupon rate, the interest applicable for that particular loan. Is it? I think.
Yeah. Okay.
Okay.
What's your question?
Then
Yeah.
question is like instead of doing reverse repo, like we can will it possible us to buy the customer's bill
Bond.
and
Yeah.
later bill or bond and later can we sell it, like
Of course you can.
instead of doing a
Yeah.
Okay.
So the reason that a customer, okay, there are two things. The one is obviously the customer has to be willing to sell his bill, right? Some people might
Okay.
just, like you said, want to give it as collateral for a short period of time and then say, look, I just want to give my 2-year bond to you for 3 months and raise money for 3 months. So he might be happy keeping that instrument. He just wants to post it as collateral for a short period of time. In other words, he wants to fund it. So for example, he's bought a bond for 2 years, right, at 10%, and now interest rates are 5%. Now he doesn't want to sell that bond because it's giving him good money, right? It's giving him a good yield.
Yes.
Good coupon. So he wants to just fund it because he needs some short-term cash requirement, right? So he say, okay, I don't want to sell it, but I'm willing to give it to you and as collateral and borrow money from you. Yeah, he does that. But
Okay.
if you as a bank would think, okay, fine, I want to buy that bond, I don't want to sell it, right? I don't want to just repo it. I don't want to lend money on a repo to this guy. Then what would you do? You say, okay, tell me what you will sell. And now he's not going to sell it to you at the 10% he bought it at. No, he's going to want to sell it to you at the current market. If the current market is 5%, you say, okay, I'll sell it to you based on a YTM of 5%, which basically means he makes a 5% capital gain on that. So it's up to you whether you want to buy that at 5% now, because you're only going to get a yield to maturity of 5% on that. Yeah, you're not going to get the original yield because the original yield he bought it as is his money, which is built into the price he paid. And when he sells it to you, he'll be selling it to you at a higher price. Okay. But okay, so now you buy the bond. Now you buy the bond at the new YTM of 5%. Now, once you buy the bond, it's yours. You can do whatever you want, right? So then you have the bond with you. So now you're earning the yield to maturity and the coupons. Based on the yield to maturity, you've paid a certain price for the bond and you're earning a certain coupon for the bond, right? Now, what do you do with that later? You are happy to keep it, you keep it as your portfolio. If you decide you want to sell it because you no longer want the bond, then you have to go out and sell it in the market like the guy you bought it from sold it at the current market rate yields. If the yields have gone up to 10% again, you will lose money, right? Because you have paid it, you have received it at 5%. Now you are going to go out and sell it to somebody, and that guy is asking for 10% because the yields have gone up, right? So when you buy some instrument, you're looking at two things. You're looking at the price you're paying for it, which is a direct factor of what the market yields are. Secondly, you're looking at the coupon you're going to get paid and the type of the coupon, like we discussed. You know, what is the coupon you're getting. Based on the coupon, your price will be determined, right? And then you look at what portfolio you're going to put it to. You can decide, is it going to be part of the bank's long-term strategic portfolio, like hold to maturity portfolio. Then you buy it based on that. Like, obviously, you buy it based on the interest rates you want. You need, you think these interest rates are good to just buy the asset and keep it. If interest rates are low, like it is now, I wouldn't buy buying bonds. I won't be buying bonds at 5%, 6% because for example, I might feel interest rates are going up further. In that instance, I would rather repo. And I would just basically invest my money short term to somebody rather than try and buy long-term bonds at this stage, for example. But if interest rates go to 10, 11%, I could say, okay, I don't want to repo, I want to buy these bonds. I want to buy this and hold it in my portfolio. So it's a direct factor. You can do it, but it's up to you what your individual situation might be, basically. It's like anything else, right? If the price goes up for something, like for example, if the price is 30 million and you want to buy something, you think, my gosh, it was 10, 20 million, now it's 30 million, it's too expensive. I don't want to buy that now, but I will rent it. Like a car, you say you want to buy a car that is 30 million or whatever, right? Now it is 30 million, I don't want to buy it, but I want to use that car. So I'll go out, instead of buying it, I'll go and rent it in the market now, till the price comes down, and then maybe I'll decide to buy it at that point, or maybe not. Your decision is based on how much you have to pay for it and what you require. But you still might want to buy it at 30 million if you have a genuine requirement for some other reason, or before you feel the price is going up even further. Then you will buy it, even at 30.
Okay, yeah. That you mean that once you sell, you have to wait until that particular day to buy. The date you sell, you can't decide whether to buy or not. You have to wait until whatever the period.
No,
that is the idea, no? Because
if you sell a bond, right, and you want to buy it back, it's up to your view on what you want, how you want to build your portfolio. If I have sold a bond today, if I have sold for example, you remember how we did a gap change in the gap, right? If I sell a 30-year bond and I buy a 10-year bond, my overall assets will be the same, but I've changed my duration.
Okay.
Yeah. Because I feel it's better to hold short-term assets without holding long-term assets.
Okay.
So that's one strategy. Or I can say I want to sell all my bonds and wait till I think everything is all the bond yields are going to go up. So I'm going to sell everything and wait for the price to go up before I buy the bond again. It can depend. It depends on where the market is and what the situation is at that point in time.
Okay, but the issue is like at the date where which you sell the bond, suppose you want to buy the same bond on future date, but that will be a different yield rate, not the same yield you sold.
Exactly right. Exactly right. And you can sell
because once we sell, other party won't give us unless it's on not the market deal.
Yeah. So once you sell it, it's gone. You go into the market and buy from different people or anybody, same person, you don't know. You are buying the same instrument, but you can be buying it from different people. But it's valued based on the YTM at that point in time. The yield to the coupon, the yield to maturity at that point in time. So the yield to maturity is what values the bond, because the coupon is the same, the face value is the same. The yield to maturity is what keeps changing along with the time period, of course, remaining. So if you sell something today and you want to buy that in 6 months, same thing you want to buy back in 6 months' time. If it's a 5-year when you sold it, it's now 4.5 years. So the time has changed. Duration will be impacted by time, right? The number of coupons may have changed because you may have got a call. There might have been a coupon paid already. So take that into that affects the price. And then when you sold it, the YTM could have been 10%. Now the YTM could be 6%. Yield to maturity could be 6%. So then obviously the price you pay will go up because the yield has gone down. So you could be buying it from the same person or different person. That doesn't matter. But it will be valued based on those factors at that point in time.
Okay. Then suppose if the period is 7 days, like less than 1 month, in that instance also the yield need to be adjusted according to the number of whatever the days.
Of course, yes, definitely, yes.
Okay. If not, you can go for the reverse repo, like rather than
Reverse repo is based on tags along with usually money market rates. Central bank sets and the reverse repo is more inclined to a money market rate, not to bond yield, because it's a short-term funding.
Correct. Correct, money market trade.
It's just the collateral you get on the bills. That's it.
Okay. Thank you, sir.
No problem. Thank you very much for everybody and everything. Thanks for the questions, and hopefully we'll see you all soon. Okay.
Thank you, sir.